Hello and welcome to Triage, timely conversations for healthcare professionals, a podcast created and produced by K&L Gates. Each episode is designed to highlight important developments in health law and analyze the impact on our clients and friends of the firm. We hope you enjoy this podcast.
So welcome today to the episode of Triage, where we explore the latest insights and trends shaping the healthcare industry. My name is Matt Miller, and I'm a partner at K&L Gates, where I focus on healthcare M&A. K&L Gates, if you don't know, is one of the world's largest law firms with nearly 50 offices globally and a national healthcare practice that spans both the East and West Coast of the U.S. I'll be your host today as we explore the topic of rep and warranties insurance, RWI. In particular, it's used in healthcare transactions. Joining me is Andrew Lloyd, a partner in the Charleston and New York offices of K&L Gates. Andrew focuses his practice on counseling both publicly and privately held entities, including private equity and venture capital firms, in connections with mergers, acquisitions, divestitures, and other negotiated transactions in a wide array of industries. Andrew has a particular wealth of knowledge and experience when it comes to rep and warranties insurance that I think will be interesting for our clients and listeners. So Andrew, welcome to the podcast.
Matt, how are you doing? Thanks for having me. Glad to be here.
Thank you for making time. Rep and warranties insurance has been a topic that has really just been on my radar my entire practice. I think going back as long as I can remember, and I think maybe in the late 90s, I read somewhere, I think that maybe 1998, the first rep and warranty insurance policy was issued. And it's become a fixture of the M&A landscape today. I think what would be good if we could just talk a little bit about what is rep and warranties insurance, and then we can get into the role of rep and warranties insurance in the M&A process. And then we can delve into specific aspects of how M&A is used in the healthcare industry. So starting out at the top, so what is rep and warranties insurance? How would you define its purpose?
Yeah, sure. So taking a step back, rep warranty insurance, RWI, RW insurance, whatever nomenclature you want to give it. The product is essentially an insurance policy that steps in to underwrite coverage for the representations and warranties made, in a M&A transaction agreement, merger agreement, asset purchase agreement, equity purchase agreement. In the absence of rep warranty insurance, if the buyer is looking for recourse for breaches of those reps and warranties made by the target company or by the sellers or both constituencies, they have to look to the sell side for recourse. You typically through a contractual indemnity claim. Warranty insurance essentially steps in and takes over that role, which essentially offloads some exposure for the sell side, in addition to providing some benefits to the buy side as well. It's underwritten by insurers, so a third party who comes in and conducts their own diligence, really backstopping or sort of looking behind the diligence conducted by the buy side. And then provides an insurance policy that's negotiated to provide cover for those breaches of reps where they exist.
Right. So you have a seller who's selling a business or an asset, and then you have a buyer who's buying the business or acquiring the assets. And those parties will make reps and warranties to each other in the purchase agreement. And if one of them's breached in the absence, like you said, of rep and warranty insurance, the source of recovery would be a lawsuit against the buyer, for example, against the seller. But under this situation with rep and warranty insurance, you have this third party in the mix that now comes in and says, you know what, I'm going to insure against the breach of the seller's reps, and I'm going to give the buyer insurance for those. So how does that benefit the parties in case of a buy-side policy? Because I think you have buy-side policies and sell-side policies. Is that right? Like, how does a buy-side policy really benefit the buyer in an M&A transaction?
Yeah, sure. So we've got, that's right. There's buyer side policies and seller side policies. And just to touch on this briefly, a buyer side policy is which is far more frequently seen in the market, is purchased by the buy side. It's essentially an insurance policy, a contract between the buy side and the insurer that's providing the coverage. In the event of a breach of rep or an alleged breach of rep made by the target company or made by the sell side, as it were, the buyer would turn to the insurance policy to recover in full or in part for the relevant losses. In the seller side policy, it's the sell side that actually obtains the insurance, and rather than looking to the insurance for recovery for exposure, essentially it would be the buy side making a claim against the sell side, which would be paid out by the sell side, and then the sell side essentially looks to the insurance policy to recoup losses. I think perhaps the main reason why sell side policies are less frequently seen relative to buy side policies is the sellers are generally going to be held to know about the business that they're selling and that they own and that they're selling. And so essentially sell side policies don't provide recourse or cover in the event of fraud or known issues on the part of the sell side, whereas buyer side policies should respond even in the event of fraud by the sell side. Of course, the insurer is going to look to be able to subrogate back against the sell side there. But they would, it's buyer side policy typically, subject to the other terms and conditions, would pay out, would provide cover in the event of a rep breach made by the target company, that rises to the level of fraud. Whereas the sell side, seller couldn't really recover under a sell side insurance policy for a breach of a rep that they knew was false.
Is the main benefit, or one of the key benefits, is that it just helps the parties get to closing, that it just smooths out a lot of the negotiations around the reps and warranties in the transaction and helps them to the extent that there's anything that hasn't been detected in diligence, or if there's any question, it sort of gives the buyer additional comfort that post-closing they will have insurance, or they'll have a source of recovery for those losses. Is that basically it?
Yeah, I think that's one of the main drivers and benefits to sort of both sides is that it, in essence, it increases efficiency in negotiating a transaction. Whereas in the absence of rep and warranty insurance, there's perhaps maybe more protected battles around the specific wording of particular reps and warranties. In the event that this is, and I imagine we'll talk about this in a bit, but in the event that it's, a full sort of walk away transaction, like a public style transaction where the sell side has zero indemnification obligations, sort of absent fraud, or exposure absent fraud, and the insurance policy acts as sort of the sole source of recovery for breaches of the reps, I think sellers look at that and say, okay, I've got a lot more comfort providing perhaps more buyer favorable reps in terms of dollar thresholds or scoping of the reps around operational matters, because so long as I have, I don't know that the reps are false, and I've undergone sort of a reasonably diligent sell side exercise in terms of looking at the business and disclosing against the reps that are made. I'm pretty fine with it because I'm not going to be subject to an indemnification claim. And on the flip side, that also provides buyers typically, right, with more cover. They get more robust reps. Again, they have to go through you can't use the insurance as a way to avoid diligence. I think, you still have to go through a legitimate, reasonable buy-side diligence exercise that involves, the applicable third parties, outside legal diligence, in-house legal diligence, where there's the expertise. Typically you need a quality of earnings performed by a reputable independent accounting firm. And then other diligences, the specifics of a transaction warrant. But you can typically get, really robust reps and really good coverage under these buy-side insurance policies. So, I think there's really numerous benefits to both sides that you see with the presence of rep and warranty insurance in a transaction.
Right. But like you said, it doesn't cover everything, right? So you could potentially find something in diligence and the insurer is going to exclude that from coverage, right?
Yeah, that's a great point. Rep and warranty insurance, is not a way to provide cover or obtain, recourse for known risks, right? Every insurance policy out there is going to include an exclusion, a standard exclusion for, known issues. Now, as over the course of negotiating these policies, there's sort of, probably a market that's developed around what does, a known risk mean? It's really sort of an actual knowledge standard. I think historically folks in the general M&A context have thought about, what's the definition of knowledge for, purposes of qualifying certain reps. These insurance policies have a definition of knowledge. It's usually actual knowledge. And essentially, what you would look to sort of the key core deal team members on the buy side, and to the extent that those folks have, actual knowledge, there's an issue, they're aware of it, they know that it constitutes a breach of a rep. That's the type of stuff that the insurance policy is not designed to cover. We typically advise folks that, for issues that come up and are identified in diligence, and they're known exposures, that's something that folks need to be aware of, may be, used as specific exclusions for cover in the insurance policy. And, that maybe means that needs to be a conversation with the sell side around a specific indemnity to cover those policy exclusions, which are in addition to, standard exclusions that are across all policies for industries generally. Insurers just generally don't cover issues like asbestos and PCBs or amounts to the extent that are taken into consideration when you calculate, a post-closing true-up around working capital. They don't cover reps that are sort of forward-looking statements. For example, like the collectability of accounts receivable. They don't underwrite, sort of guarantee the collection of AR. They don't really cover covenant breaches, right? They're covering rep and warranty breaches or inaccuracies, really. They don't sort of cover defined benefit underfunding if you've got defined benefit plans that are underfunded, if there's withdrawal liability, say, associated with like union workforces, transfer pricing, deferred tax attributes, NOLs, and the like. And then to the extent you're looking at international sort of cross-border transactions or target businesses with cross-border operations, they're focused on, sensitive areas geographically, say Russia, Ukraine, and the like. However, unlikely event that you've got a target business that's got operations that touch in those areas, those really likely aren't going to be covered under insurance policies of this nature.
So what do these policies cost? I mean, in terms of premium payments, so what is the typical RWI policy cost these days?
Yeah, so insurance policies are the premiums sort of run off of the policy limit. So coverage limits under insurance policies here or rep and warranty insurance policies are typically around 10% of the enterprise value of the transaction. I think that's sort of like the benchmark, 10% enterprise value coverage limit with the opportunity to go a little higher. A lot of insurers offer the opportunity for additional premium purchase up to 100% of enterprise value coverage for fundamental reps, to the extent that that's something that a buyer might be interested in. But policy premiums they fluctuate, with the market, just the M&A market generally, like how active is it? And then also, I think in the last several years, we've seen a real increase in the number of insurers that are operating in this market, and which I think has helped to sort of drive down policy limits. Back in COVID era and sort of immediately sort of post-COVID, late 2021, early 2022, I think when M&A activity was particularly active, was probably policy premiums were about 5% to 6% of the policy limit in a transaction, generally speaking. That's dropped a decent bit. Right now, I think what we're seeing is somewhere around 2.5% to 3.5% of the policy limit. Now, all that said, I think there's a caveat that as you look at lower middle market transactions, you're perhaps running into minimum premium amounts. And so you're going to perhaps have, say, a minimum premium that's going to tie to a transaction of, when you get down to 15 million enterprise value or below, you may run into those minimum premium amounts. Generally, no issues right now getting coverage limits as low as 3 million with premium and retention rates that are sort of comparable to larger transactions. Again, 2.5% to 3% of the policy limit. I think for, coverage limits below 3 million or 2.5 million, 2 million, once you get below that, really start thinking about minimum premiums.
So talk a little bit about costs then in connection with the terms of the actual M&A agreement, right? The purchase agreement. Because I think you talked earlier about the knowledge definition and how that can have an effect about whether things get excluded or not excluded. And there are terms in the actual purchase and sale agreement that, I'm talking about materiality scrapes. There are terms that can effectively cause your rep and warranty insurance policy to become more expensive or less efficient at protecting those claims if those terms are present in the agreement. Can you kind of go into that a little bit and, really with a view towards, parties just sort of understanding about the need to make rep and warranty insurance as effective and so the buyer gets the benefit of the policy Can you talk a little bit about that?
Yeah, sure. So at a higher level, all of these policies are really going to have sort of a retention, and when I think about insurance policies and how they interact with an acquisition agreement, I typically use the word deductible to describe sort of a deductible in the purchase agreement, right? Say for example, there's a $1 million deductible in the purchase agreement's indemnity, right? The buyer can't recover for, say, a general rep breach claim until they've got losses in excess of $1 million. And then you go above the $1 million, so like a true deductible there. The insurance policy have a similar structure, right? That's a retention under the insurance policy. Several years ago, the sort of market standard retention for a rep warranty insurance policy was, typically 1% of enterprise value. And again, I think several years ago, before we saw an increasing amount in sort of zero seller indemnity transactions where the seller effectively has no exposure for rep breaches, again, sort of absent fraud, the sellers and the buyers would typically split the insurance policy's retention. If we say it's a 1% enterprise value retention of the policy, you would essentially have a 50 basis points true deductible in the purchase agreement. And then that second 50 basis points of the retention under the policy would be sort of covered through similarly sized indemnity escrow. So again, like if you look at the policy working with the purchase agreement, you have a general rep breach claim. Okay, it's subject to the deductible in the purchase agreement. It's always going to be subject to the policy retention. The first 50 basis points of loss are borne by the buy side through the retention in the policy together with the true deductible in the purchase agreement. And the second 50 basis points of loss are borne by the sell side because the buy side looks to the indemnity escrow in the purchase agreement and recovers there. And then for losses in excess of that, then the retention in the policy is fully eroded. So the buyer's looking to the policy.
So to kind of tranche it out a little bit, say you have a $10 million policy, and is that policy coverage limit, is that set by the cap on indemnity, or how is that set?
So the limits of liability under the policy, again, I think you typically look at, a percentage of enterprise value. So again, I think sort of 10% enterprise value is more or less the market standard for an insurance policy limit of liability, and then the size of the retention, again, I think historically had most commonly been 1% of enterprise value. In recent years, and we've seen that drop a decent bit, to the effect that we now fairly frequently see quotes for insurance policies and, transactions where the initial retention is, maybe as low as 50 basis points of the enterprise value, 0.5%, and at times even lower, depending on the transaction. I think that, again, that reflects the increasingly competitive nature of the rep and warranty insurance market, the number of players that are willing to provide and underwrite coverage and issue policies in the insurance market here with this product. And then also generally, I think, the sort of slowdown in the M&A market more broadly, this year and sort of, towards the tail end of last year as well. So, it created an increasingly competitive sort of buyer favorable market for obtaining favorable policy terms and coverage economics and the like.
So let's shift gears here then. That's really interesting and helpful. But let's talk a little bit about specific considerations in the healthcare industry itself. So healthcare, as everyone knows, is one of the most heavily regulated of all industries. There are several laws, whether it's HIPAA, whether it's anti-kickback at the state and federal level, whether it's cyber security issues. I mean, there's lots of unique risks in healthcare M&A. How have you seen rep and warranty insurance play a role in healthcare transactions, and has that trend gone in one direction versus another?
That's a great question, Matt. I think that looking at it historically and consistent with the trend, the upward trend in the number of carriers willing to underwrite and provide this insurance product in the M&A market, if you go back 5 years or so ago, there, really weren't that many insurers that had an appetite to cover and provide coverage in the healthcare industry more broadly. I think as folks sort of started to dip their toes in around sort of COVID era, it was not uncommon to get maybe one quote from an insurer, maybe two or three. which is vastly different, I think, from, what you saw in other industries where you'd get at least a half dozen, if not a dozen or more, insurers that were willing to provide competitive quotes. If you go back to sort of 2020, 2021, the quotes that you did receive, if you got them, typically had, some unfavorable economics, again, higher premiums given the risk that the insurers perceived in the industry for underwriting coverage, for the reasons and or they were taking concerning exclusions that really sort of undercut the benefit of the policy. For example, not willing to underwrite, any sort of billing and coding related issues. There were in, I think, 2021, some large claims and sort of the, DME space that really gave insurers pause for concern around covering acquisitions in the healthcare industry. I think, again, as the, insurance market has expanded, as the M&A market has picked up and the deal activity has picked up, and particularly as private equity buyers have increasingly focused on the healthcare space, that has given insurers armed with, I think a better, a more refined understanding of the risks associated with the healthcare industry and, M&A within the industry, more comfort in underwriting coverage. I think they're going to, you're always going to have your deal specific exclusions across every market. And I think, in the healthcare industry, depending on the target and what it's doing, and within the healthcare industry, you're going to have, your fair share of heightened underwriting risks that carriers are going to focus on. But I do think that in this market right now, it's you got a good opportunity to get favorable quotes, to get competitive quotes, not just from one carrier, but from multiple carriers. We've seen some, more favorable deal terms or coverage terms in insurance policies more broadly, but within the healthcare industry. I think you mentioned cyber issues. It typically or historically, carriers looked and said, hey, for a cyber issue, our coverage under the policy is sort of going to be expressly in excess of whatever coverage exists. And we want to underwrite that coverage and understand what it looks like at the target. But in any event, it's not going to be any broader than that coverage. So if the policy, the cyber coverage that exists is more narrow than what the insurance policy would otherwise provide for, you're not going to get the coverage. I think we have started to see some movement away from that, which is more, more buyer favorable in terms of a broader coverage. And I think premiums have generally, while they were historically a little higher for coverage in the healthcare industry, they've gone down and now I think approximate perhaps maybe at the higher end of the, premium range more generally in the market, but, within that range, which I think is positive for buyers in the healthcare industry in particular.
Yeah, I mean, I was always told that the billing and coding issue in particular was one of the issues that would cause rep and warranty insurers to stay clear of the healthcare M&A market. But that seems like it's changed recently, and like you said, insurers are getting more and more comfortable with providing for those coverage for those types of claims. Have you seen any, are there any additional, and I'm thinking like audits, billing and coding audits, diligence report outs, like what can parties do to get an insurer more comfortable or get the coverage over certain items if the insurer is, for whatever reason, having cold feet or thinking they're going to exclude a certain claim?
Yeah, so I think one of the first things that a buyer can do is, at the outset of a transaction process, whether it's a proprietary transaction or it's part of an auction process. Obviously, you're always at the whims of, in an auction process in particular, how quickly you're forced to move in order to win or keep the transaction. But, as early as possible, assembling your in-house team of specialists who are going to work on the transaction and lining up outside counsel, lining up your outside accounting firm who's going to perform the quality of earnings, lining up your insurance broker, whether that's, your broker who handles insurance for you more generally, more broadly, or if you're going to use a particular group at a brokerage firm that is specifically for rep and warranty insurance. I think that the more in front of a transaction and the diligence that you can get, the better, right? The more time you have to identify risks, and then the more time that you have to decide how to deal with those risks, the better. Going out to market, and essentially what I mean by that is going to, have the buyer having the insurance broker take the transaction to market with the SIM, with the financials, if there are audited financials at the target, and the SIM being the management presentation information memorandum, whatever's been produced or available in connection with marketing the target business, and a draft of the purchase agreement to the insurance market to get quotes. The sooner you can do that, the better, because then you can identify what quotes look like, particularly in terms of economics, but also what are the heightened underwriting risks that the insurance market perceives. So again, like for billing and coding, particularly if the target company has a significant level of government reimbursement, that's I think you can expect that that's going to be something that an insurer is going to focus on. So do you need to line up a third party to conduct a billing and coding audit? Probably so. In order to one that obviously that identifies issues. But even where our issues aren't identified, having a reputable third party come in that space, conduct their work. Again, I think that goes a long ways to getting an underwriter comfortable that even if no risks were, identified, that the work was done to try to uncover those risks, and that, for XYZ reasons, that should be an insurable risk. And, to the extent that issues are identified as part of diligence, having your advisors or your in-house folks or whoever's looked at that in particular, the more time they have to think about it in advance of the underwriting call with the insurer and their advisors, the more time you have in advance to think about it before you feel like you're in a position where you're under the gun to sign the purchase agreement, the better. Because if and when a deal specific exclusion comes down the pike from a carrier, they say, hey, look, we're just not willing to cover this risk. Or there's this known issue that's been identified. It's not just a risk, but there's actually an issue here. The company's facing, this amount of economic exposure as a result of this risk. We know that there's non-compliance with law in this area, even though it's not going to be covered under the policy. Say, for example, again, like a known violation of law, that gives you, I think, as a buyer, some ammunition to turn around to the sellers and their advisors and say, look, we know this is supposed to be a rep warranty insurance-backed transaction. This isn't covered. This is an issue. It's non-compliance with law. We know it. You should know it. And here's how we have to handle this. And typically that's, is it a purchase price reduction? More commonly, is it some sort of an escrow with specific, indemnification provisions around it that are perhaps different from the general indemnification provisions in the purchase agreement, that otherwise addressing rep breaches?
Well, that's really interesting and helpful, Andrew. Thank you for covering those. I think let's take a break and come back. And when we come back, we can talk more about some of the practical tips for structuring and negotiating rep and warranty insurance, some pitfalls, and maybe the future of what the outlook is for RWI and M&A in general. So let's keep it here, and we'll come back for a second episode of rep and warranty insurance and M&A. Thanks.
Thanks again for listening to Triage, timely conversations for healthcare professionals. New episodes are available for download through Apple Podcasts, Google Podcasts, and Spotify. By subscribing to Triage, you will receive timely notifications for each new episode. Also, if you have any topics you would like to hear discussed on Triage, please don't hesitate to email triagesupport@klgates.com. We would love to hear from you.